Welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita Khemka. Well, not turning out to be a very good session, but some respite given the fact that the Nifty has recovered 90 odd points from the day's low. So we did test that 25,900 level on the downside. 25,891, that's the swing low for today. But from there, we've done well to recover. We are around the 25,969 mark or so. But we've seen a good recovery when it comes to the Nifty Bank Index. That index is almost 250 to 300 points off the day's low. Around that 59,300 mark. So, in terms of the swing lows for the Nifty Bank Index, we had taken out that 59,000 mark. But from there, we've done pretty okayish to recover. But if you look at the broader end of the markets, there's no respite there. We've seen a 1% cut on the Nifty Midcap Index. The breadth is extremely poor. Once again, 2:5. That's the advanced decline ratio as we speak. So yes, the pain in the broader end of the markets continues and gets more pronounced as the rupee. That's the biggest talking point today. The rupee slid past that 90, the psychological level of 90. In fact, the record low for rupee is 90.28. At the current juncture, it's around that 90.1 mark. But sharp slide on the rupee, especially since November 18th. When we got the trade deficit figures. Since then, the rupee has been in a downward spiral, and that 90 level, that psychological level, has also been taken out. So yes, worst performing Asian currency this year, and in a matter of months, we've seen 4 to 5% being shaved off from the rupee. So that's one thing that we will be, of course, talking about and keeping a lookout for, given the fact that we also have the RBI policy later in the week. Whether or not this rupee factor impacts the rate decision, that's the big question in the market right now. But in terms of sectors, barring IT, all the sectors are trading in the red. IT pack was trading high by about 0.7% or thereabouts. In terms of the laggards, of course, PSU banks, big laggards, 3.5% cut, and that was because there was a clarification of the government saying that they are not considering any plan, or there are no plans to actually increase the FII limit. So I think in the anticipation of that, we had seen PSU banks rallying quite a bit in recent times, but now this clarification has really weighed in on sentiment, which is why we are seeing stocks like Indian Bank selling off in trade, and the PSU bank index down in excess of 3%. Autos, metals, oil and gas, all of these sectors are trading deep in the red. Just taking stock of some of the individual laggards and gainers on the index then. It's the IT pack that's keeping the index afloat, you can say, given the fact that we've recovered smartly from the day's low. Wipro, TCS, Infosys, these are some of the counters that are among the top gainers on the Nifty. ICICI Bank and HDFC Bank, mind you, yesterday they were the big laggards on the back of weight adjustment on the Nifty Bank Index. But today they are providing support to the Nifty Bank Index, which is why the Nifty Bank Index is significantly off the day's low. In fact, as we speak, the Nifty Bank Index is in the positive territory. Aside of that, you have some metal names like Hindalco featuring on the gainers list, and so are the likes of Sun Pharma and Dr. Reddy's from the pharma pack. Nevertheless, the gainers list is fairly slim. On the laggards list, we have the likes of Max Healthcare. That stock, by the way, is down 7% on a week-to-date basis. Adani Enterprises, Bharat Electronics, some consumption names, Titan, Tata Consumer. These are some of the names that are on the laggards list. The likes of JSW Steel are also down. Of course, there's been some bit of news flow on JSW Steel, and it's reacting to that. That was down somewhere around 3% at one point, but pulled back from those lows. Shriram Finance, Interglobe Aviation, Tata Motors Passenger Vehicles, these are among some of the other movers. We'll take stock of the mid-cap gainers, losers in just a bit, but let me first introduce our first guest on the show, Nitin, Bhasin, Head of Institutional Equities at Ambit, joining in. Nitin, lovely to have you on the show this afternoon. Since the time we've hit record highs on the indices, we've taken quite a sharp U-turn. In fact, also given away that 26,000 level, the psychological level, and of course now the rupee weakness, that's also weighing in heavy on the stocks, and we can see what's really happening with the broader end of the markets, which, by the way, hasn't even participated in this leg of the rally. Here on, what's the strategy? What is it looking like? Amid all the gloom when it comes to the forex markets, should one stick to the safety of large caps and avoid bottom fishing when it comes to mid-cap names, because mid-caps, some of them have shaved off 30-40% from their highs. So there is a dichotomy in the markets. How does one really navigate?
Thanks for having me. I'm going to repeat the same thing which we've been talking as a house for the last closer to about 14 months to 15 months now, September last year. That this is a sideways market, where it means that there's no a definitive trend to the upside or the downside. But however, in the market cap cohorts for the last 14, 15 months, our view has been large caps is what holds up, doesn't make you lose money. Some mega caps within that will perhaps not make you lose money, in names like Bhartis and the Reliances of the world, or the HDFC banks, or certain large cap ITs. But the mid caps and the small caps in the country will be a difficult proposition on an index basis to actually outperform the large caps. And clearly, we see that in the market every now and then. Hence, I would still maintain my strategy of rising concentration in the Indian markets, and that is all happening amid a number of small cap and mid cap IPOs taking place. The recommendation still remains, getting into the next calendar year, that at least for the next 12 months or so, we don't see this trend reversing of large caps outperforming the mid caps and the small caps.
Okay, stick to the large caps. That's the clear call then. But let's talk about the biggest story of the day. That's Rupee. Went past that 90 level. Of course, we have an RBI policy also later this week. Do you think the RBI will take the Rupee factor into account while deciding on a rate decision? Of course, we've had the strong GDP data, 8.2%. That's the real GDP figure. And we have record low inflation as well at the same time. So any which ways, there was a dilemma as to whether or not to dole out a rate cut right at the current juncture or not. But now, will the Rupee factor also come into play? What are your thoughts on that?
So, again, I'll go back a little bit in the history and say that for the last 12 months or 12 months back, we written a note on the rupee that if you look at the last 5, 10, 15, 20, 25 years, the Indian currency typically depreciates closer to about 3.5% here and there on a CAGR basis. On a median basis, also, it just depreciates closer to 3.4% or so. So the last 1 year or so, the rupee has been pretty strong. If you see for the last 1 year or 1.5 year, perhaps a strong political environment, despite all FDI or FPI, which was not turning from negative or let's say neutral to positive. Actually, it's been more negative. So hence, I would say it was a lot of belief on India's export potential, reforms taking place, political environment, which was leading to a lot of rupee stability, I would say, and perhaps RBI also supporting over there. But now I think there are multiple factors playing in the backdrop. One, which could be a government wanting to perhaps be a little bit flexible on the rupee to promote export opportunities, because remember, the trade deal is in impasse right now. So the exporters want more countries, more regions to export to. So hence, could that be the reason that we are letting? Perhaps it's been nearly a good amount of time that the FPI and the FDIs continue to remain not so positive, or let's say negative and declining. So that's not changing at all. Hence, I think, and the RBI perhaps being flexible, as I said in the beginning. Now the question comes in to the valid point that you also brought up, is we don't think that there will be a rate cut in this particular quarter. Perhaps they might leave it for the fourth quarter. The GDP print was very good at about 8.2% or so. So hence, in that particular context, what's the need for a rate cut right now? And if you do that, it could actually not work in the favor of rupee also, if you to go for another rate cut right now. So hence, I would say, I think rupee is catching up with its long-term trend. There is a trade deal impasse. We need to support exporters, and we have not been able to reverse the flows of FDI or FPI. So perhaps all of those are catching up in the sharp snap move over the last month.
All right, that's the point. Of course, counting down to Friday to know what the RBI really does. But just want to point out, the market has staged kind of a very good recovery. The Nifty is around, it's in fact back above that 26,000 level, and the Nifty Bank index is showing a lot of strength now. It's up almost 100 points or so, and the Sensex has managed to come back into the positive territory. So, some bit of recovery creeping in. So, good point is that I think we've taken out the 20 DMA level on the index. Now we are back above that level. So, if we close around these levels, at least on the index level, it will be heartening to see that we've recovered quite smartly from the day's low. But let's talk about banks in general. PSU banks had run up quite a lot in anticipation of some reforms in the form of FII limit hike. But yesterday, there was a clarification in the parliament that there is no such proposal that's being considered, and which is why I think we've seen PSU banks take it on the chin today. But does this strengthen the case for investment in private banks? Because PSU banks were rallying on the back of or on the hopes of more reforms coming in. But I think in terms of bank consolidation as well, there has been some clarification, which is why such a sharp fall. So if those don't come through, would you say that the case for investment in private sector banks would strengthen?
I would tend to agree with you, and that's why whilst I would actually like to make a disclaimer here that banks is not our top sector pick right now, because in the markets of rising consolidation, we have generally seen in the past FMCG, pharma, or for that matter, IT hold up better in the sideways market or the concentrating market. So banks is not our top pick. But within the banks, we spoke about this a month back, 2 months back as well, that is the private sector banks. Perhaps it could be an SDFC relatively, which could be top ideas over here. And perhaps, as we go into the next calendar year with some bit of improvement in the credit growth, if the GDP, nominal GDP remains closer to about 10-11%, should help the large cap banks, the private sector banks. And you rightly summarized it, that it's the snap move of people moving out of the public sector banks into private sector banks like an ICICI or an Axis or an HDFC Bank during the day today that must be leading to this particular move. We'll still continue to highlight things like HDFC Bank should be better off, or even some regional banks in India preferred, private regional banks preferred over public sector banks right now.
All right, that's the view then, private sector banks being preferred over PSU names. Now, just going through your earnings reports, I think you guys have pointed out that gross margins expanded only in 5 out of 16 sectors. I think utilities, oil and gas, these are some of the sectors where you found that gross margins have expanded pretty smartly, which have been the clear winners according to you of the second quarter earnings season. And going forward, can one safely assume that FY27 will be a year of double-digit earnings growth, given the fact that first half of FY26 has seen more upgrades than downgrades, which has been a positive surprise?
I think the second quarter was pretty much a good surprise for us, because even though our broader market call has been underweight small caps and mid caps, the earnings performance of the mid cap and the small cap was slightly better than where we started the quarter with, though the gross margins did not expand. But I think the general concerns were weaker for the whole earnings growth expect in the country, but especially the mid caps and the small caps. So hence, I'd still maintain that as we go into the year, you would have very uneven trends in consumption, in very uneven trends in lending. So I would prefer more consumer names, more geared towards rural, because over there people might premiumize their purchasing behavior. So that could be the one. What we have to watch out for is urban consumption trends, though the GDP actually gives us the confidence. But remember, we are also picking up some moderation in real estate, some moderation in travel, some moderation in things such as upper premium innerwear or hotels, etc., real estate. So hence, let's see, the gross margin expansion trends are more across more sectors is weaker than actually stronger. So hence, if I go into FY27, the earnings consensus numbers is closer to about 14-15%. But history shows that we go through moderation of, but we are building in closer to about 12 to 13% earnings growth today for FY27, at least in the Nifty.
Okay, that's the call. 12 to 13% earnings growth for FY27. That's the expectation. Let's talk about some of these, OMCs, oil marketing companies. Given the improving profitability and steady capex plans, do you think the space still offers investment opportunities? Because stocks have seen a good run. If you look at the last 3 months or so, would you be looking at this pack?
We have always believed in profit pools in India versus the valuation market cap pools in India. Clearly, OMCs, stack up one of the large cap companies, large cap sector, where profitability has been there. But I think the investors still continue to be split because they believe that there can be a lot of government intervention. Tomorrow, perhaps they can be actually forced to bear some subsidies, etc. I think those things are behind us, and hence our energy analyst has been highlighting OMCs as relatively preferred to the gas plays in India over the last few months.
Okay.
And we also see that these are relatively large profit pools available at reasonably inexpensive valuations compared to the entire market.
Okay, OMC is the preferred play within the energy pack, preferred over gas sector. But let's talk about the IPO frenzy. One cannot touch upon that because there has been a barrage of IPOs that have been hitting markets, and most of them have been consumer tech. How does one really value them? And most of them have either just about turned profitable or are yet to turn profitable. How does one really decide whether this is the right time to get into it? Because we've had stories like Zomato, which were loss making, but 3 years, 2 years down the line, they have turned profitable and they are giving good returns as well. So how does one make that decision as to whether or not to get in right now, or wait for things to fructify, to things to get profitable, and then make an entry? How are you guys valuing the recent IPOs, and what are your thoughts as a house?
I think the near-term valuations, whether it is price to sales or whether it is price to earnings, are very easy relative metrics and to do. But I would say the good analysts or the good investors, they're defining their long-term horizons of how these businesses perhaps could actually shape up over the next 5 years, 7 years, and 10 years. They're trying to understand or imagine how the network effects could actually play out for new businesses that they can launch. 5 years back or 7 years back, hardly anybody would have been thinking about giving a valuation to quick commerce of Eternal, which is Zomato at that point in time. So I would say still our team is looking at valuations of these companies with a little bit of a skepticism that one has to think about in the long run, how much burn is required. We still believe a lot of these businesses like Swiggy will require a lot more burn. Perhaps, the entire space of quick commerce may not be, as less penetrated in terms of dark stores, which we all think. I don't think so in India right now. We are yet reached that 300 million people are the users of most of these consumer tech companies' offerings. Beyond the 50, 60 million people are finding it difficult for them to actually pay up. And hence, companies will have to either roll up to buy smaller companies, find new business models, or go international, as what we see in the case of Lenskart. Some of these are very, very good businesses. Perhaps the prices of their in the marketplace could be different. Urban Company is a very different model in the world, which has come up. Generally a good business, I think so. But however, the valuations, because they need to still build a business, which is, quick service, house help at a particular price, which is very, very low. Let's see how it plays out. We don't cover the stock, no recommendation. But the sense is today, many of these companies are operating or perhaps getting valued as new age companies, winner takes all, and a large demographics of India should become the consuming class for all of these businesses offering. So hence, I think such a simplistic approach to valuation is behind us, and that's why you're seeing in the IPOs today. Whereas you can see your frenzy, I would say there's a lot of pushback on the valuations from the institutional investors to many of these small cap, mid cap, and large cap companies. Starting point to closing point could be anything between the 20 to 40% lower in terms of the expectations of the valuation. Some moderation is taking place. Some will happen, perhaps, as the time goes by.
Sure, fair point. Last question, really. Anything on the manufacturing side that you like? Because we saw good GDP figures, real GDP figures, 8.2%, largely led by government capex. But second half, as capex slows down, do you expect private sector to step up and take the lead? If yes, anything that you like within the capital goods space, construction space, where investors should position themselves to play out that recovery in private capex?
I think in India, the private capex, we've been waiting for it for a little more than a decade now. It comes in spurts and perhaps doesn't got momentum. We still continue to see people talking about investing, but I think the sums are not increasing the way our country requires them. The government has actually given a lot of incentives, whether it was PLIs or whether it was, some sort of a duties for imports, for import substitution, and now even relaxing the labor codes, which is a very, very good reform. But it by itself alone, it will not be enough. We need to manage power costs. We need to manage land availability and land costs. And we need to think about much bigger special economic zones. We read a few days back that is also under consideration. I think in manufacturing, there are many examples for manufacturing for India, manufacturing for international markets. But again, thematic based valuations for many defense companies, many EMS companies have become very punchy, and even capital goods. But there are continuing to be examples, in country without going into names. I think there are a handful of EMS companies that are doing very good, if not all of them. Some of them are priced very, very punchily. Capital goods, we've covered companies like Inox recently. We've covered companies like, in the past, Anup Engineering. We've looked at companies like Amber. We've looked at certain other capital goods companies like GMM, the small cap companies, some of them, but equally there are large companies like LG, which is a consumer company and also a manufacturing company. So I would say, rather than saying manufacturing, because chemicals is also manufacturing, I would say good quality companies
Yeah.
are available in India a lot, but good quality companies available at reasonable valuations to make money in the next 12 months are very less in the manufacturing space, especially
Very
in the
less.
EMS space.
Absolutely. That's true, yeah, Nitin. But with that, Nitin, I'll have to let you go. We are out of time. The list of questions is long, but we are, short of time. But let's save it for another day then. But thanks a lot for taking out time and joining in this afternoon. Always a pleasure, and have a good rest of the week.
Thank you. Thanks for having me. Thank you.
Thanks a lot. Well, on that note, let's shift focus to the markets once again. We've again slipped below the 26,000 mark. 25,980 is where we are at right now. Just about 4 minutes to go for the markets to shut. The currency remains around that 90.1 mark. That would be, if it closes around this level, of course, that will be the first close, past that 90 mark. So yes, that's something to watch out for. Midcap index, although it's down, it's kind of rebounded slightly from the day's low, but it's still down almost 1%. The bank Nifty is the index that is, that has in fact made a very, very smart recovery from the day's low, over or almost 300 to 310 kind of points kind of recovery from the day's low on the Nifty bank index in the positive territory. And you've got heavyweights like ICICI Bank and HDFC Bank. I think those are the top two contributors when it comes to the Nifty bank index. But the Nifty PSU bank index, that's taken a sharp turn. It's down 3%, of course, on the back of clarifications on FI limit hike and the consolidation plans as well, taking it on the chin. We've had quite a few laggards from the Nifty PSU bank index. But on that note, let me bring on board our technical analyst for the show today, Ashish Bahety, technical and derivative research analyst at ProfitMart Securities. Ashish, lovely chatting with you. We've taken a about turn after hitting record highs. All of the week we've been, in a downward spiral thanks to the movement in the currency market. But what is it looking like? Nothing to complain as such, because from the day's low, we've staged a good recovery. Can't say the same about mid caps, but the index is back around that 25,000, 980 or 970 levels. How are you feeling about it? Do you think the spurt of recovery that we saw in the last few minutes, would it carry over to tomorrow, or will the currency determine which way we'll head?
Good afternoon, Nandita. Yes, it's been a good recovery, and Nifty has just touched 20 daily exponential moving average, which acts as a strong support area. And Nifty has just bounced back from that. So Nifty, didn't give up all its gain, and managed to stay afloat above 20 daily exponential moving average, which is a positive sign for the Nifty. Yes, there's been a bit of correction in last 3 4 days, but I'll say this has been a healthy correction. And it's given another a fresh opportunity to enter the long position. Overall strength of the market looks really good. The way Bank Nifty has recovered has been very significantly impressive. HDFC has again above 1,000 mark, which was acting as a resistance, and ICICI, the way it's contributing, it's now almost touching 1,400 zone, which is very positive. On the daily charts also, ICICI just moved, surpassed its 200 daily exponential moving average, or I'll say it's regained its 200 daily exponential moving average. A fresh momentum can start from ICICI from here, and which can easily lead both Nifty and Bank Nifty to fresh new levels. So we remain positive on the both the indexes. We're using this opportunity or this dip as a buying opportunity, and anybody who's going long here should strictly keep a stop loss of today's day low, which is almost like 25,900 would be a good stop loss, 80 points from here. On the upside, we see 26,200 or 350 mark to be touched in the coming weeks.
All right, that's a view, a healthy correction in the market, and of course, commendable the way the Nifty Bank Index has staged a turnaround and in fact managed to end the day in the green. But let's quickly take stock of the closing as well. Ashish, just hold that thought. We'll come back and talk about individual names as well. Nifty below 26,000, but 25,985. That's where it has shut shop. So 25,900, although was taken out on an intraday basis, we did well to defend that level on the downside as well. But if you look at some of the other indices, we've spoken about the Nifty Bank Index, ended the day in the green, but the broader end of the markets, disappointment continues there because the Nifty Midcap Index is down 1%, advanced decline ratio remains weak, 1:2, that's the NSE advanced decline ratio. PSU Bank Index took it on the chin. Some of the notable movers on the Nifty PSU Bank Index, of course, SBI down 1.5%. Indian Bank, that's the big one, that's lost somewhere around almost 5.5 to 6%. PNB, Canara Bank, Bank of India, Bank of Baroda, all of these names saw sharp cuts across the board. What's managed to hold out is the IT sector that was the top sectoral gainer. Of course, exporters stand to benefit from the rupee fall, so 0.7% kind of a gain coming in for IT, but Nifty Financial Services as well ended the day in the green, aside of the Nifty Bank Index, and the Nifty Media Index also managed to end in the green. Aside of PSU banks, autos were the big laggards today, some profit taking there, 1.5% down. Energy, FMCG, real estate, metals, these were all deep in the red. In terms of individual names, very quickly, in terms of laggards, Max Healthcare, Adani, some consumption names like Tata Consumer, Titan, JSW Steel. There was a news around the GFE Steel JV, so that stock also tumbled, but it did well to recover from its lows and ended lower by about 1.5% or so. NTPC, ONGC, these are some of the other laggards. On the flip side, Wipro, TCS, top Nifty gainers. ICICI Bank, as even Ashish was mentioning, did well to recover quite smartly. So did HDFC Bank, but Hindalco also did well from the metals basket, and some pharma names were up and about, Dr. Reddy's and Sun Pharma in a weak market. Let's talk about Indian Bank and some of the other PSU banking names. After today's 3 to 4% fall, would you turn cautious, because the move has been led by some news flow on the fundamental side, right? So in that sense, what's the chart really saying? Could we expect some kind of trend reversal and more weakness in the coming days for PSU banks?
Certainly, Nandita. I mean, as I was speaking, ICICI just moved above its 200 daily exponential moving average, and where I'll speak about PNB.
Hmm.
So PNB was like today high was almost 125, and its 200 daily exponential moving average is placed at 105. So that's approximately like 18 to 19% stretched out from its 200 daily exponential moving average. So most of these banks have seen a vertical rise or a vertical inclination towards the peak, and some of them even hit all-time high trajectory. So yes, there's a steep correction or there's a good profit taking, I'll say. Investors should stay away, or even the traders should stay away from these banks. I'll say there's a reversion trade happening here. Some of these trades might even revert back to their some of the means and averages. Uh, the go-to pocket is private sector banks right now, specifically ICICI and Axis.
Hmm. Okay, the go-to pocket is private banks, and I was talking to Nitin Bhasin of Ambit, and he also had a similar view. What about NBFCs? The likes of Shriram Finance have come under pressure. Of late, Shriram Finance has been witnessing selling pressure, and today all three, Shriram Finance, Chola Finance, AB Capital, even L&T Finance for that matter, they were all under pressure. How would you approach NBFCs?
See, it's a very notorious space. Some of the NBFCs are doing good, and some of them are really like in pressure. Stocks like LIC Housing Finance and the other NBFCs in the housing finance space are in huge pressure. But however, stocks like Bajaj Finance is consolidating, so one have to be very picky and choosy here. We are bullish on stocks like Muthoot Finance and Chola Finance. However, on the other stocks, we are still neutral to negative.
Okay, got your point. So be selective within the NBFC basket. But let's talk about JSW Steel. The stock did take a sharp knock, but it ended off the day's low. JFE Steel is going to form a 50-50 JV with JSW Steel, and it will be a JV for transfer of BPSL, I beg your pardon, Bhushan Power and Steel Integrated Steel Facility. Now, JFE will be investing 15,750 crore in the JV for transfer of the BPCL integrated facility, and it will be acquiring 50% equity stake for JSW Kalinga for, as I mentioned, 15,750 crore in two tranches. So, it will come to somewhere around 31,000 crore rupees or so. I think the street was disappointed by the price, which is why I think we saw such a sharp knock, because this development I think was already known by the market. So I think it's the price that played spoil sport, which is why the stock saw a sharp knock. Would you look at this dip as a buying opportunity, especially given the fact that steel names, along with the entire metal pack, has done exceedingly well in the last few months? So is this a healthy dip, and should one buy into it?
Yeah, so from the metal, we are actually more bullish on the non-ferrous side rather than the ferrous steel, ferrous metals.
Okay.
But however, talking about JSW Steel, yes, the recovery which played out is really impressive. Stock went almost touched 1100 zone during the intraday trading session, and we've seen the last half an hour of the trade, stock rebounded well and almost able to close 2% up from the low point. So this looks impressive on the charts. However, we'll initiate a fresh buy when the stock crosses above 1155. So another 1% rally from here. Our buy signal will be initiated. And if that happens, if the stock able to cross above 1155, we may see even 1200 close zone in the charts. So, however, stock has made a strong support near the 1130 area.
Hmm. Okay, 1150, a strong support on the charts of a JSW Steel. But let's focus in on a capital market play, talking about Angel One. The monthly operational data was fairly subdued. In fact, gross client acquisition has also declined 17% year on year in the month of November. The stock did react to it 6% down. uh, how would you look at this correction? Last 1 month, the stock had done well, but in recent times, last 5 days or something like that, you will see that the stock has lost some bit of that steam. How would you look at this particular chart within the brokerage space?
The stock was consolidating, and it was 2700 was acting as a strong support area. Even stock was holding above its 20 daily exponential moving average. But in today's trading session, we've seen a massive selling in the stock, and even if you'll see the open interest part, there's a short built up on the stock. Even the volume have been higher on the higher side compared to the average daily volume. It's almost twice of the average daily volume. We'll have to see how much was the delivery volume in this. But stock looks negative on the charts, and we think stock may slide back to 2500, 2550 area. And if that is getting broken, so stock may even see 2500 zone. So anybody short should remain negative on the stock. Just trail the SL to 2720.
Okay, that's the view on Angel. But let's talk about some of the gainers as well. We've just been focusing in on losers. DOMS Industries, that stock was in focus today, saw good gains. Antique has initiated coverage on the stock with a buy call. I think it sees somewhere around 30% upside from current levels. Is it catching your fancy? DOMS Industries, what are your thoughts?
Yes, I mean, today's price action has been very good. I mean, this weak market, the stock was able to, you've seen a good buying or a price volume action in this stock. Almost 1.8 million shares have been traded this in DOMS. The way it has given a breakout, it looks really impressive. We think chartically the stock may head to 2700 or even a level beyond that. The strong support area for the stock has become established at 2550.
Okay, strong support at 2550 on the charts of DOMS Industries. But since we're talking about stocks with good volumes, today Root Mobile saw its biggest gain and volume both in terms of price and volumes both since June 2024. The stock also moved above its 50-day moving average of 730 or so. Stock still is down somewhere around 45% in 2025 so far. What would you make of today's price action in a stock like Root Mobile?
Yeah. So, I mean, I'll say this stock has been under huge pressure, and it's been a nightmare for most of the investors because we have seen one-way selling in this stock, and most of these mid-cap IT or the tech stocks have rebounded from the lows, but this stock was in a continuously selling pressure. But the good part is today was the first day of reversal, and this holds or this reversal sustains. We may see 800 kind of a zone or trajectory soon on the charts. But probably today is the first day. We'll be closely watching this stock. If this surpasses 720 area, 720 zone, which is like another 2-3% move from here, it may initiate a buy for us for the next probable target of 800. However, the strong support area which has become the charts is 680.
Okay, 680, that's the strong support level on a Root Mobile. But, Spark, this stock, it did gain in the initial part of the session. Yesterday, of course, it saw a 20% up move, but I think it completely reversed that trend and ended lower by about 6.5%. Was it about a profit taking? How would you read into the sudden pressure that the stock saw?
So yes, even it's been in during the intraday trading session, stock did touch 179, and there was a massive selling from that zone of 170 plus area. And stock, slipped back to 150 zone, but yet it's still on a weekly chart is still looking a positive. The breakout has been there in this week, so we'll be closely watching this stock. I think one can go long here by keeping a strong stop loss of 145. We assume that the rally may continue on the upward side, and stock may hit 180 trajectory soon.
Okay, stock may hit the 180 trajectory soon on a spark. But, let's talk about some of these export-oriented names as well. Of course, IT was up and about today in a weak market thanks to the currency movement. If you were to play this, rupee fall, which really stocks would you play? From the IT pack, some of these textile names, export-oriented names, which ones would feature on your list if one were to purely play it from a trading perspective?
So certainly IT has that valuation comfort, and most of the stocks have been trading near to their moving averages, mean key moving averages. So there's no stretched out chart in the IT, and specifically the mid cap IT. The way Birlasoft has moved from the recent their close is looking good on the chart. Even the stocks like Forge or Emphasis is looking very impressive. We've been very bullish on the persistent. The stock has taken some knock in today's trading session, but however, it's still near to its 52-week high trajectory. So we remain bullish on the persistent, and any dip in persistent can be used as a buying opportunity. The large cap IT, we are still negative, but however, on the mid cap IT, we are very bullish.
Okay, mid cap IT, we are really bullish. That's the call. Some stocks that hit a fresh 52-week high today, I think were the likes of an Asian Paints as well. The stock has of course seen very good traction in the last 1 month. Yesterday as well, there was a report from UBS wherein they upgraded the stock. The stock was up and about. Today ended flat with a negative bias, but the management was on CNBC TV 18 and they've said that double-digit growth is just a couple of quarters away. So good commentary as well coming in. From the paint makers, would you take a bet on Asian Paints, Berger, anything else? I mean, how are the charts poised, and what kind of an upside do you see on these names?
Yes, Asian Paints has been on our radar. Even we have given a recommendation last week itself on Asian Paints, and even during the start of the month of November, we initiated a buy coverage here for the next probable target of 3,000. Stock is just near or hovering near close to the zone of 3,000. But we think if the 3,000 zone is surpassed, or it's able to conquer the 3,000 trajectory, stock may move even up to 3,200 or plus levels. So stock is looking good on the charts. Every dip is getting used as a buying opportunity. And stock is, even in the fall, stock is able to take a support near its 10-day exponential moving average, and again continue to move on the upside. So it is looking good. However, there's a strong support stock which has established near 2,900. So one can go long here for the next probable target of 3,000, and if that is getting achieved, the next probable target would be 3,200.
Okay, 3,200, that's the next target on Asian Paints. But Ola Electric, that stock was down and out 5% today. Any thoughts? It's, I think, hit a fresh 52-week low as well.
Yeah. So the stock has been under huge pressure, and I think it's not just 52-week low, it's all-time low for the stock. So every
Yeah, all-time low.
news flow or every commentary by the management is used as a selling opportunity by the investors. So we are very negative on the stock, and it's absolutely a void category stock for us right now.
Okay, absolutely avoid. That's the call. Any thoughts on the likes of Aavas Financiers? That stock was also, on the list of 52-week low stocks. From the housing finance names, anything there? How would you look at the weakness?
So some of these stocks have been huge pressure, stocks like Aavas Finance and even LIC Housing Finance and even Bajaj Housing Finance is in pressure. But however, I think out of the entire space, if one stock you have to pick, probably LIC Housing Finance is one stock which we think is due for its reversal, and it's near its support area. So one stock is that, and another probably from the financial space. Geo Finance is looking good on the chart. Stock has again back to its 300 strong support area. We anticipating that stock may take a support here and then move on the upside for the next target of 315.
Okay, LIC Housing and Geo Financial, those are looking attractive from the housing finance basket. But I want to draw your attention to trend. This stock hit a fresh 52-week low today, and of course, it has been an underperformer this year. It has really almost halved from its 52-week highs as well. How much more downside should one look at when it comes to this particular stock? It's below that 4200 mark. In fact, 4191 right now. Can it test levels of 4000 as well on the downside?
See, on the chartically, stock has broken all its support area, and it's all again back to almost, I'll say, 2024 April trajectory. So the gains made in almost last 1.5 years, stock has given up all that gains. And on chartically, I think even 4000 is possible on the charts because this doesn't seems to be any support which is now holding for the stock. Every pullback is getting used as a selling opportunity, and stock is not able to manage to even close above its 20 daily exponential moving average. Any pullback can be used as a shorting opportunity here.
Okay, any pullback in the stock is a shorting opportunity on trend. That's the call. But we're running out of time. Ashish, before I let you go, any recommendations for our viewers?
From the metal space, Hindustan Zinc is looking good. It's been on our recommendation list for quite some time now. And the way these precious metals are moving, I think Hindustan Zinc is well poised to move to 540 zone, 520 to 540 target area. So one can go long here by keeping a stop loss of near 495.
Okay, Hindustan Zinc, that's a recommendation coming in from Ashish. Ashish, with that, would like to thank you for taking out time and joining us. As usual, I look forward to our next interaction as well. Till then, thank you for joining in. And on that note, take a look at some of the stocks that are on my radar this afternoon. Angel One, that stock saw a sharp cut. Shares fell over 5%. The gross client acquisition in November fell 17% year on year. It's the November update that came out, and that was subdued. The operational metrics were looking fairly subdued, which is why the stock tanked from around 5% or thereabouts. Its client base, however, continued to grow. As I mentioned, gross client acquisitions declined nearly 17% year on year, but the client base increased almost 22% from the year ago period. In fact, number of orders also dropped over 10% year on year, while average daily orders fell 15%. Based on the option premium turnover, its overall average daily turnover for the month increased nearly 98% year on year. But the average turnover from futures and options declined almost 5.5%. Now, based on the option premium turnover, the company's overall retail equity market share increased by 18 basis points. That was year on year to 20.3%, while its futures and options retail market share fell by 46 basis points to 21.5%. If you talk about the commodity turnover market share, that declined 719 basis points to 52.5%. Now, shares of Angel One are down somewhere around 10% on a year-to-date basis today as well. Saw a sharp cut of somewhere around 5% or thereabouts. Aside that, another stock that's on my list was a gainer in trade in a weak market. That's DOMS Industries. Antique broking house Antique has initiated coverage on the stock with a buy call. Target price is at 3,250 rupees per share, which implies a near 30% upside from current levels. Now, the brokerage believes that the company is well poised to grow at a faster clip in the overall consumption space through capacity addition, distribution expansion, and strong innovation pipeline as well. If we talk about the sales CAGR, a compounded annual growth rate, that was at 24% over FY20 to FY25. Now, the brokerage says that this 20% growth rate is likely to continue between FY25 to FY28 as well. So, the revenue CAGR run rate is going to continue for the company over the next 3 financial years. That's what Antique believes. But why does it feel so? Now, there are 4 factors behind it. phased commissioning of a new facility in Ambergaon that will address capacity constraints. The company is scaling up fast in growing categories, the likes of pens, papers, kits, as well as combos. The company is also expanding presence in adjacent categories, bags and toys, and also looking at acquisitions, Uniclan, which is baby hygiene, and Super Treads, that's paper. And lastly, the company is focused on profitable portfolio expansion through innovators. It has added as much as 500 SKUs since FY24. Meanwhile, management is also confident of achieving its annual turnover growth target of 18 to 20%, supported by capacity expansion, new product launches, and deeper market penetration as well. I think the stock of DOMS has done well on a YTD basis. As far as I know, it's up somewhere around 10% or so. The stock will come up on your screen. Let me just check and see how much it has gained on a year-to-date basis. No, the stock is down 4% on a year-to-date basis, and if you look at the last 6 months' performance, it has given positive returns of somewhere around 6% or thereabouts. So those were all the stocks that were on my radar this afternoon. But in terms of the market movement, we did well to recover and close just a shade below that 26,000 mark, given the fact that we had taken out the 25,900 mark on the downside at one point in time on an intraday basis. 25,891, that's the swing low, and the index in fact had tested its 20-day moving average level as well. So yes, that was tested, but we did well to recover from those levels. But the talking point, Rupee slid past that 90 level, 90.28, that was a record low. That of course took a toll on the market sentiment. We've seen broader markets seeing deeper sell-off. In fact, the Nifty Midcap index is down over 1%, and breadth is also fairly poor. But banking names provided support to the index, the likes of ICICI Bank, HDFC Bank. They did well to recover quite smartly from the day's low, with the Nifty Bank index as well ending above that 59,300 mark and in the positive territory with gains of somewhere around 75 points or thereabouts. That was the overall market for you net. But of course, let's see how things really pan out tomorrow. We have the RBI policy outcome on Friday. The MPC meeting is underway, the 3-day meeting. So yes, whether or not a rate cut comes by or not, the street is fairly divided now with the rupee sliding past 90. We'll have to see whether the rupee fall also gets taken into account, and whether or not the RBI governor or the MPC rather comes hands out a pause, or just to revive animal spirits, they give out a 25 basis point rate cut nevertheless, and who knows, we'll get to know only on Friday. But with that, we are completely timed out on this edition of Closing Bell. Thanks a lot for tuning in. Stay tuned to Moneycontrol for all your other news and updates, and we'll see you with the markets tomorrow at 9 a.m. with opening bell. So don't forget to tune in. Have a great evening.